This is Unit 13, Escrow and Title Insurance. Okay, you've done it. You did your marketing. You secured yourself a buyer or a seller, and through the offer process, consummated a contract. Now what happens? Well, now you go into escrow. And what escrow does, they're a neutral third party that will take the contract in, formulate escrow instructions, and be an agent for both parties, the buyer and the seller. They'll bring in the loan documents. They'll sign the buyers up. They'll, of course, receive the earnest money deposit. And then when everything is ready and all the funds are good funds, meaning all the checks have cleared, then they'll close the transaction. Once it's funded, meaning the mortgage loan has closed, then the grant deed will go to the county recorder and get recorded, and that's closing. So once the deed's recorded in the new buyer's name, then that's closing. So what escrow will do is they operate in an agency capacity for the buyer and the seller during the course of the escrow. Once it closes, then they're finishing up as the agent for the buyer and the seller. They're an impartial stakeholder in the transaction. Once a sum of money has been offered from the buyer to the seller and the seller's acceptance has been received, meaning transmitted to the buyer, then a binding contract is formed. And with that binding contract, the earnest money deposit will go into escrow. Once everything goes into escrow, the broker should track the escrow and make sure that the escrow is receiving all the documents that are required through the escrow instructions and the contract. One thing to remember, get some help in that regard. Get a transaction recorder, transaction coordinator, commonly called a TC, to help you with that. And they'll have a checklist to make sure that all the documents that should be coming in are getting through and going to escrow. Once you have the acceptance, then you need to open escrow. So at that point, both parties have signed the contract. That will go to escrow along with the deposit for the escrow, commonly called the earnest money deposit. Escrow holds all the money and all the documents. All monies received, whether they be cash or cashier's check, personal checks, all have to be cleared. Once they're cleared, then you have good funds and you can close the escrow. I will also caution you, cash can be a problem too. If somebody brings in over $10,000 as a deposit into escrow, that's going to trigger a notice to the IRS. I have an old war story where that happened to me, where I was representing a buyer and they had somebody that was going to co-mortgage with them and actually give them a gift for their portion of the down payment. It was $65,000. Well, I didn't know it at the time that that person was a bookie in Las Vegas. So when they came in with the cash to close, they basically brought a lunchbox in with $65,000 in it. Well, that money had to be traced. It blew the escrow, and we couldn't close because they brought in that amount of cash. Once a buyer has performed in full, then they get a grant deed. Basically, the seller grants title over to the buyer, which gets recorded with the county. Up until that time of close, sellers retain title as security until all funds are transferred. Now, during the course of the escrow, the seller will sign a grant deed ahead of time, but it's not recorded until everything funds and gets ready to close. On the lender side, the escrow helps out and they will sign the buyers, and that mortgage becomes a credit on their side of the closing statement. So very simply, ignoring all the other costs, but say, for example, you're buying a home for $500,000, you're putting down $50,000. So to make up the $500,000, you have a $50,000 deposit you put into escrow. Then you have a credit for $450,000 on your side of the escrow statement that shows your mortgage coming in. You're borrowing $450,000. So the 50 plus 450, you've got $500,000 in escrow. The broker is not a party to the escrow unless the broker is a principal. Who can be an escrow company? Most escrow companies are licensed by the Department of Corporations, so they're corporations themselves. So that corporation must be licensed under the escrow law. There are some exceptions, however. Banks can perform escrows, attorneys can provide escrows, title and trust companies can do that also. In fact, this is normally done in Northern California, where title and trust companies act as the escrow, in addition to doing the title report. Savings associations can be escrows also. A broker can be an escrow also, as long as a broker is a party to either side of the transaction. So they must be representing either the buyer or the seller, and then the broker can handle the escrow. Many brokers do escrows, but they need to remember that there are some reporting requirements by the broker. If a broker conducts 5 or more escrows in a calendar year, or conducts escrows totaling over $1 million, the broker must file an annual report with the DRE, Department of Real Estate. And the report must be filed within 60 days of the end of the calendar year. And once again, for a broker to be able to do escrows, they must be a party to the transaction, so they represent either the buyer or the seller. So if somebody's going to start an escrow company and apply with the Department of Corporations, they need to pay a fee and pass a background check. The company must have some minimum finance requirements, where they have to have at least a $50,000 net worth, and $25,000 of that has to be liquid cash in the bank. Managers must have at least 5 years experience in escrow. They need to furnish a $25,000 to $50,000 surety bond. They must have a $125,000 fidelity bond for each responsible employee. Requirements of escrow licensing. An escrow must belong to an escrow agent's fidelity corporation. They must have a trust account, and all monies deposited need to be paper trailed. So if a deposit comes in, they have to keep an accounting of that money coming in and going out of the escrow. They need to keep accurate records. They are subject to audits by both the Department of Corporation and the Department of Real Estate. And they must submit an annual independent audit. Of course, there are some laws governing escrow. No escrow licensee may make misleading or deceptive statements referring to its supervision by the state of California. They can't describe a transaction not to be included under the state definition of escrow. And all monies need to appear on the HUD, Housing and Urban Development closing statement. So you can't make a side agreement saying, hey, Mr. Seller was going to give you $1,000 for new carpet in your transaction. How about after we close, we'll have the seller just write you a check for $1,000. Can't do that. It has to appear on the closing statement. You cannot, as an escrow, pay a referral fee to anyone other than its own employees. Just like in RESPA for a lender, an escrow cannot go out and talk to real estate agents about giving them their escrows and they'll pay them $50 at close of escrow. That's illegal and violates RESPA. They can't solicit or accept any escrow documents with blanks to be filled in at a later time. Escrow instructions are written directions from principals, seller, buyer, lender, and borrowers, to the impartial third party, the escrow agent. The escrow officer then does everything necessary to carry out the escrow agreement per the wishes of the principals. If there happens to be a difference during the course of the escrow between the escrow instructions, and the purchase contract, the escrow instructions generally prevail because they were signed at a later date, a more current date, expressing a final agreement. You can't, however, amend an escrow. Once signed, the escrow is bound to carry out the instructions. Neither the buyer nor the seller can unilaterally modify the escrow agreement once it's signed. So even in the case of the mortgage, if something changes, say somebody decides instead of putting $50,000 down on their property, they want to put $60,000 down. Well, the buyer just can't call escrow and say, hey, we're going to change this. I'm going to put $60,000 down instead of 50. That has to come out in the form of an escrow amendment where the seller and the buyer sign it, and that will amend the escrow. Of course, you see a lot of brokers trying to direct an escrow, but we have to remember that the broker is not a party to the escrow and cannot order any changes. The brokers can just deliver a change request from the principal they represent and convey that to escrow. If an escrow fails, meaning it cancels, both parties must agree to release funds less the costs and fees. So once again, there has to be mutual agreement. The seller just can't call the escrow office and say, hey, I'm canceling this agreement. I'd like to cancel this escrow. What the escrow officer would have to do is contact both parties, not only the seller, but the buyer, and get mutual agreement, and then the escrow can be canceled. If a party refuses to agree when there is not a good faith dispute as to who is entitled to funds, that party can be liable for treble the damages, or not less than $100 or more than $1,000. So there has to be agreement before the escrow is canceled. Here's some escrow terms, and I'll start out with this one. It is closing costs. Closing costs are one-time charges that don't happen again. An example would be an escrow charge, a title fee, a processing fee, an underwriting fee from lenders, and of course the escrow costs. Recurring costs are things that happen again and again and again. For example, property taxes and insurance, interest on the new loan. So the closing statement will also let people know the amounts of taxes due, insurance, and interest on the loan. The buyer may wish to have an impound account on their loan, which is a trust account that their lender has for taxes and insurance. Normally the buyer requests that. So if they want an impound account, normally what happens is the escrow officer will take the first 6 months taxes due, plus probably a couple of months to set up the impound account, because property taxes are always prepaid. So they'll take 6 months, pay the first 6 months taxes, take an extra 2 months, and start the impound account for the lender. Likewise, you'll do the same thing for the insurance policies, since a property has to be insured immediately before close. So what they'll do is take the first year's insurance payments, pay that, and then take a couple months also to start the impound account. So the first year's insurance is closed, they'll take 2 months, and then the buyer, via his impound account, will start saving up for the next year when the insurance is due, and then it gets paid out of the impound account. Beneficiary statement and the demand statement are fairly similar. Basically, the beneficiary statement is a lender statement for the loan balance. We're going to be paying that off. Let me know how much you owe. The demand statement is a little more detailed in that it'll be the payoff plus any fees included. There may be a reconveyance fee, meaning I'm paying off. That's normally about $60. And there could be interest and penalties outstanding on that loan. And that's the demand statement. I'm paying you off. Let me know down to the penny what you owe. And we'll pay it off through escrow. So a reconveyance is a deed from the lender to the seller, clearing the loan so that the title can be clear, and that'll be recorded against the title to the property, showing that that loan has been reconveyed and paid off. Closing costs, again, are one-time charges. So that could be appraisal fee, credit report fees, escrow, title, processing and underwriting fees, so one-time charges. Contractor fees may include termite reports, repairs up for the termite report. They can also be paid through escrow. And of course, you will prorate some things that are an agreement between the buyer and seller as far as who owes what. A good example of a proration might be that, say, for example, the seller who's selling the property, it's his investment property, and it's March 1st, and the closing is going to be March 15th. Well, the seller accepted rent for March, so they collected $3,000 for March rent. Okay, on March 15th, the escrow closes, so the seller no longer owns the property anymore and only owns and only has rights to half the rent because the buyer owns the property from the 15th forward. So what the escrow officer would do would prorate that $3,000 and give the buyer the rents due from the 15th on, which would be $1,500. At closing, separate closing statements are issued to the buyer and also to the seller. Each shows debits, or the amount owed, and credits, the amount due to that party. The difference between the buyer's debits and credits are adjusted by cash payments, meaning your down payment plus your mortgage coming in. So those are both credits on your side of the closing statement if you're a buyer. The difference between the seller's credits and debits is paid to the seller in the form of a check. So at close of escrow, normally they'll get their closing statement and a check attached, which would be their equity from their sale. There are truth in lending requirements and respite requirements at close of escrow for 1 to 4 units. They need to have a closing disclosure prior to the close of escrow. So what will happen is a lender will normally email the closing disclosure for signature, which they can e-sign. The buyer will e-sign the closing disclosure. From that signature, there's a 3-day closing period before they can close the transaction. So after the 3 days, the loan will fund and then close. Title insurance. Title insurance basically insures the marketability of a property, meaning that it has clear title and can be conveyed from the seller to the buyer. So a title company will do an abstract of title to make sure that's in the case and there are no liens, clouds, or encumbrances against title, and then insure that to make sure there's clear title for close of escrow. Subsequent purchasers are not protected by that seller's title insurance policy because things could have been changed during that time. What will happen with the new purchase transaction, they'll get new title. The CLTA, which is the California Land Title Association policy, which the seller normally pays for, and the ALTA policy. ALTA policy a lot of times too is called a lender's policy because it's an extended coverage title policy that benefits the buyer and the lender. On the standard policy, or the CLTA, which is the seller's policy, the coverage covers matters of public record, forgery, lack of capacity by a grantor, undisclosed spousal interests, failure or of delivery of a prior deed, federal tax liens, deeds of a corporation whose charter has expired, deeds of an agent whose capacity has terminated. There are some things not covered by the standard or CLTA policy, but guess what? The ALTA or lender's policy picks those up. And they would be defects known by insured, but not disclosed by the insurer, zoning, mining claims, tax and assessments not yet due, easements and liens not a matter of public record, and rights of parties in possession. Also not covered would be matters not a matter of public record, matters that would have been revealed by a correct survey, water rights, reservations and government patents. In Southern California, the seller generally pays for the standard or CLTA policy, but oddly enough, in Northern California, it's flipped around. The seller is going to pay for the ALTA policy or the lender's policy, and the buyer will pay for the CLTA policy. The extended or ALTA policy or lender's policy, in addition to the coverage of the standard policy, also covers unrecorded liens, off-record easements, rights of parties in physical possession, rights and claims that a correct survey would have revealed, mining claims, water rights, and lack of access. There are some things excluded from the Alta policy. The extended coverage policies do not cover matters known by the insured but not conveyed to the insurer, meaning the title company didn't know about it. Government regulations such as zoning. Zoning can change. It's called police power. So say, for example, that you live in a community that is currently zoned as residential and it changes down the road to commercial. There's no way to know that's going to happen because it's something done by the government. And of course, the title company was unaware of it and cannot insure for that change. Liens placed by the insured, meaning the buyer down the road has a first trust deed of $400,000, decides to go out and get a second trust deed at $50,000. Okay, it's not covered by the extended coverage title insurance. Eminent domain, once again, the government comes in and condemns an area for a freeway to go through. Well, the title company would have no way of knowing that, so it doesn't cover eminent domain and violations of the MAP Act. Prior to the issuance of the policy of title insurance, the insurer, early in the transaction, will be issued a preliminary title report. Very important to go through that. As an agent, you should go through that with your buyer or whoever you're representing, whether it be the seller or the buyer. It's important to make sure and look to see if there's any liens, clouds, or encumbrances that could affect the closing of your transaction. For example, you may have a judgment on there that the seller has to take care of prior to closing. And maybe that's something they couldn't. Maybe it's a $100,000 judgment and they don't have the cash to do that, even with the equity they're pulling out of the transaction. The preliminary title report, or PR, indicates that the insurer will issue a policy, meaning they'll issue a title policy subject to the stated exceptions. You need to look at those exceptions and make sure that's something that will not jeopardize your closing. The PR, preliminary title report, itself does not insure anything. It's just a statement of fact at this point regarding the title of that property. So as far as closing goes, if there's a loan involved, what happens in sort of a chronological order is the lender will send out the CD, or the closing disclosure, to be signed. Once that's signed, then escrow can prepare documents. And of course, there's a 3-day cooling off period from the CD, so the documents can be signed after that time. So they're signed at the escrow office. What also happens during that time is the escrow officer is preparing the grant deed for recording. So then once the loan funds, usually that day or the next day, the escrow officer will send the grant deed to the county recorder for recording. Once that's done, they'll do the settlements on both of the closing statements, the seller side and the buyer side, and send those closing statements out showing the disbursements of funds. Of course, the seller will get their equity out, so they get their closing statement plus a check. That could happen to the buyer too if they brought in too much cash or something. It's settled up, so they may get their closing statement and a smaller check for overpayments and deposits. So during that time, it funds or records, and during that time, what the escrow officer will do is cut checks for commissions also. So all the agents can pick up their checks at escrow after closing and recording.